Good morning, everyone. We're so grateful to have you here today. This is a extremely exciting topic for us here, the psychology of market headlines and staying calm in noisy times. This is one of our favorite topics to talk about, and what a perfect time to walk through this with all the geopolitical uncertainty that we're having and kind of what's all flooding our headlines. If we are still looking at the news, I know we've talked many times about not looking at it, but what a perfect time to walk through this, especially with we really haven't felt downward volatility in quite some time, probably over 12 months. So having a day where it opens up down 2%, it's just a great time to reiterate a lot. For a lot of you, today will be a review. I know you guys are all great investors and really understand this, but we're extremely passionate about it and feel like it's our role to walk through this with you consistently over time. So before we do, as always, we begin in gratitude. For myself today, I'm extremely grateful for a morning where I got to watch the sunrise over Lake Michigan while I went for a little bit of a run, and it was perfectly clear, no wind. The Lake Michigan was just clear as glass, and it was just a wonderful way to start the day. So that's what I'm grateful for today. How about yourself, Peter?
Thanks, Zach. I am grateful for toddler milestones. We have a 2.5-year-old at home, so we are going through the fun stages of potty training right now, and she has definitely turned a corner for the better, which is making mom and dad's lives easier. And it's just fun to see her growth in that area.
I cannot wait for those days. We have a couple of years ahead with our 14-month-old. But how about yourself, Ben?
Thanks, Zach. No, I'm just grateful for our wonderful family and friends that I have in my life, for all the supports, for the highs and the lows through life. So very blessed to have so many amazing people in my life.
Love it. How about yourself, Mike?
Yes, today's a very special day. It is our dog's birthday. So Akira turned 6 years old today. So I get to celebrate her a little bit.
Love it. How about yourself, Michael?
Thank you, Zach. Grateful today for I have a pretty special announcement of a growing Birschbach family. I'm excited to announce I'm going to be an uncle later this year. So just really excited for my older brother and to see his family start. So thank you.
Michael gave us a little bit of a scare of excitement on our Monday meeting because he said the Birschbach family was growing. And we're like, do you have an announcement here? So, but congratulations to your brother. I know he's going to be a great father, knowing him personally. So, how about yourself, Lisa?
Thank you, Zach. Good morning, everybody. So I am grateful that I was able to go to one of our technology summits last week in Florida at Raymond James to learn what's coming out in the future at Raymond James. That's going to help not only our team, but our clients. So I was really grateful to be able to go there and then extended a little bit just to get some extra Florida sunshine. So that was really nice. So back in the office, all refreshed. And I did bring some sunshine with me. So.
Yeah, I think looking at the weather, Monday of next week might feel a little bit like Florida to us here in Wisconsin, a 60-degree day coming up. So, extremely excited for that. So, without further ado, let's jump into the psychology of markets and all the different headlines and how we can really focus on our plan. But before we do, I really just wanted to share a little story and imagine yourself imagining a farmer planting crops in the spring. Every morning he walks outside, checks the weather. One day it's raining. The next day it's dry. The next day it's windy. The next day it's like, oh my gosh, it's cold. Imagine if that farmer every single day was like, I'm going to take the crops out of the ground because of the weather today, right? That's ridiculous. A farmer would never do that. The same thing for our financial plan. Just like a good harvest requires an entire season, not based off of a single day, investing works the same way. Daily headlines, like we're talking about today, are like the weather. Some days are stormy. You look at yesterday, it was a very stormy day. Some days are sunny. Everything looks good. The earnings of these companies look good. But what matters most is the full season. And unlike farming, where it's an annual season, our financial plan season is many, many seasons of growth, whether we're planning for a child's education or retirement or building out our legacy for our family in some forms. We want to act and be more like that farmer. We don't want to pull our great crops. We don't want to pull our great plan out of the ground just because of temporary news headlines. So I just thought that was an incredible story. I grew up in a town of 800 people in a farming town. So that one really resonated with me. Is like, yeah, the farmer wouldn't pull the plants out of the ground because it rains. one day. Same thing with our overall plan. And the most unfortunate thing with the news is they operate on a 24-hour market or 24-hour cycle, whereas our investing in financial planning really operates on a decade-long cycle. And the news outlets are really designed to capture our attention, which we know this, but they make money for spiking that amygdala in the back of our brain that kept us alive for thousands of years. And that fear, that urgency, that surprise aspect. And the really interesting thing when we've looked at this, and Chris has shared the perspective over 30 years with us as well, is that the market's constantly adjusting and incorporating new information that by the time the headlines usually reach us, markets have already generally priced this information in a lot of cases, which is extremely interesting to look at. And overall, our plans are built assuming unexpected events will happen. Great financial plans are really built for recessions, elections, geopolitical events, interest rate changes, market corrections in some form. I know we always go through a chart called the annual end of the world, where at some point throughout the year, the average intra-year drawdown since 1980 is 14%. Yet 35 of those 46 years have ended up positive, and not just positive, they've averaged an 11% annualized return. So we call it really the annual end of the world. And it's extremely interesting to look at over time. And before we head into Michael's segment to kind of talk about some biases, great companies offer higher long-term returns because it's uncomfortable in the short term. Volatility is a signal that something's not broken. It's simply just the price that we pay for growth along the way. And if we know that, it's easier to look at these headlines and be like, while these geopolitical concerns, or if it's war or anything like that, none of those are fun as humans to observe. But when it comes to our overall financial plan, we just know that's the price that we have to pay for long-term growth over time. And it just reminds me of something that Nick Murray, one of the mentors we often talk about, and the different things that we send to you on a monthly basis from him. He just said the goal of successful investing is not to outsmart the market, is to outlast the noise. So with that, Michael, why don't you share some, different biases that come into the psychology of the markets?
Yeah, thank you, Zach. Really well said. I appreciate the story. It's easier to kind of understand in metaphors because it gets complex and things move fast when we're looking at markets in the planning world. So to give a little perspective, I want to take a quick trip down memory lane. We're going to go back to the past about 11 months ago, so April 2025. Here's some of the headlines from a very popular financial news source that were some of the most clicked articles that month. There's 4 of them, and I'll just read the headlines. First one, stocks plunged as investors panicked over new global tariffs. The S&P 500 fell towards bear market territory. The S&P 500 loses $5 trillion in 2 days in Trump tariff sell-off. The S&P 500 could fall to 4,600, Deutsche Bank strategist says, and host warns of Black Monday market crash over tariffs rivaling record 1987 collapse. 4 articles that were written April 2025. So 3 points I want to make with this. Zach mentioned this. Negativity sells. This isn't exclusively financial news. This is typically news in general. Markets plunge, creating that shock when you see the headline. Recession warning, instilling fear when you see the word recession. Black Monday, an extreme prediction when we're looking at what could happen in the markets. We assumed what just happened is going to continue on. A bad week can feel like an entire decade. Doing something about that can feel productive, but sometimes being patient, doing nothing is the best option. Peter, the remainder of the team are going to go over some more opportunities that present itself when markets get a little bit volatile. But again, all of these articles were written within weeks of each other. And if you held the S&P 500 and throughout the year, you would have finished with a positive 18% return in 2025, with your investments seeing a drawdown of around 20% in April. Back to you, Zach.
Yeah, thank you, Michael. And it's extremely interesting to look at these different biases because they play into our lives in some form, not just financially, but in our decision making on a daily basis, where one that we've looked at over time and studied over time is loss aversion. Losses feel twice as powerful as gains. So if our portfolios went up, $100,000, just as an example, it feels really good to see that. But then if it goes down 30,000 from there, everything feels like a loss, yet we're 70,000 still ahead. And that's just how our brains work. That's not a negative at all. It's just being aware of that. And it's kept us alive for a really long time. And really just, I love how Michael said, really the recency bias. And when he talked about those headlines, it really reminded me of another bias that we researched over time, which is just the herd mentality. Over time, for thousands of years, we've survived by being in groups and being around people like us because it's safe, right? So when we look at these headlines, it's the FOMO, the fear of missing out when things are really positive, but then the panic because we're seeing other people panic or we're seeing headlines panic, where especially today with social media, financial media, constant commentary, it really creates the illusion that everyone else is reacting, and our automatic bias with that is, oh, I should react too. I should be in this too. I should be in this investment as well. We've been asked about gold and silver in the last 3 months more than at least I have in the last decade, right? Because it's the fear of missing out. It's, oh my gosh, somebody's making a lot of money on this, or I heard about this. I have to get into this. It's that herd mentality, and extremely important to be aware of. And the other one that Michael reminded me of that we've studied over time is the availability bias. And it's really that dramatic events feel more likely. So the human brain overestimates risks that are easy to recall or constantly discussed. So if the news is talking about a recession or a market crash or various political events, it's available, it's at the top of our mind because it's very simple to comprehend. Oh my gosh, a recession is going to happen. What should I do? Right. And we love these. There's tons of other biases that come into play, but I really appreciate that, Michael. How about Ben? How about some perspective over time with it?
Yeah, this is Michael set me up greatly because he did the short term. I'm going to look a little bit more long term, because how quickly do we forget even what happened a year ago, let alone what happened 50 years ago. And so I want to kind of share a quick little screen here for you guys. And I'll scroll in. Point is not necessarily to be able to read all of this, but to show every single year, there's always a reason why not to, whether that be market slumps in the 70s, Cold War tension in the 80s, the Iran-Iraq war in the late 80s, and then there's the bond market crashing, the tech bubble bursting, 9/11, the Ukraine crisis, then you have trade wars, as we just talked about. Then there's also COVID in there, and now there's the AI bubble. There's always a reason not to do something, because that's what sells is, oh my gosh, fear. But if you look back and if you just stayed the plan, stayed patient and diligent, the growth of $10,000 since this 1975, $10,000 would have became about 3.4 million if you just stayed the course. But again, it's easier said than done. We're meant to be, as we said earlier with Michael, that headlines sell. And so I'm just gonna stop sharing my screen. One of the great phrases I heard the other day was, there's never been a headline that read, markets drop, patience investors still on track. That's just not the case. Not many people click on that, but that's okay. So back to you, Zach.
I would love to see that at some point, just to see how few of clicks somebody, a news agency gets on that one. So I really appreciate that, Ben. And when we really look at that, we've shared this with you many times, and like I said, this is probably a review for you guys, but we feel like it's extremely important over time as life changes, as our goals potentially have changed. Maybe we're closer to retirement than we were in the past. Maybe have other things going on in our lives that just cause us to be at a higher state of nervousness or anxiety in some form. And really, the stock market is just this kind of unknown big thing. You talk to somebody else and they'll give you a completely different idea what it is. In the simplest form, we just view it as great companies that are continuing to innovate and adapt over time and increase their earnings over time. And as long as they continue to increase their earnings, our money is eventually going to take part in that as well. So how about Mike, talking through just, how we structure portfolios here to kind of weather those storms, if you will.
Yeah, thanks, Zach. And if this goes long, feel free to cut my mic. No pun intended. Well, maybe there was. So anyways, something that I really want to get into is that we're talking a lot about the stock market, the S&P 500. That's going to be some of the 500 greatest companies, some of the 500 largest companies, almost all of them being domestic United States companies. That's not what we own in our strategies. And I want to get down to the nitty gritty of this, that they're within the strategy, but it's a great example just to show the recovery in which exists. But in a year like last year where we saw the market go down 20%. Guess what was able to be a ballast within our portfolios? The construction of what we've created, the strategies in which we employ to make sure that your hard-earned money sticks around in some sort of way in any other moment when we see these different depreciations. Well, the answer was international. So we own a portion of international, and I can say this confidently in every single person's strategy because that's how we approach construction. Everything is tailored to the individual based on when you need this money, when you plan to spend, and what your risk tolerance is at the end of the day. And these are all things that we can coach upon and we can talk about. And we've noticed our clients' risk tolerance getting a little bit more, tolerable to risk over time as we've had these presentations about how normal situations are. So despite the headline risk, despite these things that show that the market might be depreciating, within the overall construction of your plan, of your strategy, there's going to be different investments, maybe individual stocks. More often than not, it's going to be a professional money manager taking care of your assets in some form of mutual fund or ETF that is making sure that they're making smart decisions. And when we see volatility, it gives them even more opportunity to make those smart decisions. So despite the fact that you might see an overall depreciation of 10, 15% at some point in time, we have confidence that there is something within your strategy that will be performing well in that moment, that if you need money, if we have to take care of things for you, it will be available. Now, if you're a young earner, like some who may be watching the call, some of the clients that we have, maybe kids, grandkids that are out there, sometimes there won't be something that's up when it's down. Why is that okay? Because of everything in which we showed. The S&P 500 all on its own is a very risky investment. We don't want our retirees to feel 20% down when one market is down 20%, right? There's tons of markets out there. I could go in. Indexing can be a whole nother conversation. But anyways, when you take a look at all of this, you can take a little bit more risk when you're younger because you have the time for that to recover. Now, when you're retired, you still have 30 plus year runways often. So we do want exposure there because we can wait for that recovery and we want to capture the long-term premium of equity returns. Zach, you might like that one. That was a little Nick Murray that I brought out there. But anyways, the idea just being for retirees, we want to make sure that we have something else in the portfolio, whether it's a bond, whether it's a contrarian strategy that might move in a different direction when the market goes up or down, whether it's real estate style investments. I mean, there's all sorts of different things that we sprinkle in around the core strategy that is your own strategy, and it can help you go through these volatile times. And we're ahead of it. Why we say stay the course, because a plan is built for whatever may come. So come what may, stay invested, allow things to work for you, and we'll continue to articulate, teach, and help you through those times and manage things emotionally. But just know that we got you. We're here for you when times get tough, and we're definitely here for you also when times are great. So back to you, Zach.
Yeah, thank you, Mike. And you can tell that Mike is extremely passionate about it. And we work completely together on an investment committee. As an investment committee, we look at these on a daily basis, weekly basis, monthly basis, quarterly basis. But oftentimes, Mike and Ryan lead the charge for us for some of the data points behind it and what we should be looking out for. So it's really nice to have them that passionate about what they do here at our firm. And kind of shifting gears a little bit, I'd love to go to Peter, just talk about the planning items that, headlines or uncertainty creates as well.
Yeah, thanks, Zach. And Zach did a great job earlier talking about the different seasons that a farmer may go through. While we have different seasons in the market, and we don't know when we're going to be in one over the other. And each one's not as easy to live through, right? Volatility is sometimes more emotional than when we're seeing positive returns. And that's why we focus on the planning. Mike did a great job talking about the portfolio, the investment side, why it's allocated the way it is. But the reason we talk about planning is that's something that we can actually control no matter what season we're in. And I'm going to share this quick. This actually came through in my email at 8:08 this morning and is perfect timing for our podcast today. It's JP Morgan's Guide to Retirement. And they have a slide that shows what do we actually have control over? Out of our control, market returns, tax policy. We have a little bit of control over what is our longevity, what is our earnings, what is the longevity of those earnings. But what we do have control over is how much are we saving, how much are we spending, and what does our asset allocation look like, and where are those assets held? There are just a couple examples of that, but those are true no matter what investing season we're in. So a few examples that we like to talk about when we are in those volatile times is it does really give us some great opportunities. One example is Roth conversions. We're able to convert more shares at a lower price from a traditional IRA to a Roth IRA to let that grow in a tax-free account. Another example could be tax loss harvesting. Maybe we have gains that we want to offset somewhere, and we lock in some of those unrealized losses to help from a tax planning standpoint. Rebalancing. Mike talked about our asset allocation. We have all different pieces that move differently depending upon what season we're in, that maybe we take from something that's performed better during our volatile times and buy something that hasn't performed as well, knowing that we're buying quality companies at lower prices. And then the last thing is, looking at our spending. Maybe it's time that we have a purchase we want to make, but we can hold off a little while, letting the portfolio recover before we need those cash reserves. So those are just a few examples, but no matter what season we're in, we're always looking at what planning opportunities do we have.
I love that, Peter. Thank you for sharing that. And really just looking through the lens of what we can control and what we can't control, that's really so applicable to our daily lives as well. Right now, just since it's top of mind, everything that's occurring in Iran, by no means, good whatsoever when these type of things happen over the course of human history, and they get us to feel a certain way in some form. But if we take a physical step back and look at what can we control? Can I control any of the single decisions that anyone is making over there? Can I control anything that comes out of that? What if I was so charged by that based off how I felt by that affected my relationship with my wife and my son when I came home, right? Even if it was in my subconscious that I was somehow feeling some type of way of it, and it caused me to not be as present with the people I love the most when I get home. How sad would that be? So when we really take a step back, what can we truly control? We really only can control ourselves and how we think and how we act and how we treat other people. And it just has so many interplays between life and our overall financial plan and our investments. And I really appreciate you sharing that, Peter, of what we can control and what we can't control. Before I go through some closing comments here for you guys at the end of this, I wanted to go to Lisa and just have Lisa share everything that's coming up here at Gentian that you should be aware of.
Thanks, Zach. And also another one that we can't control is happening this weekend. We do our daylight savings time a little bit early this year, but we will lose an hour of sleep, but we will gain that wonderful hour of light at the end of the day. So on Monday, when it's 60 degrees, we're going to get that till about 6:30 at night. So that's going to be feeling like spring again. So it'll be really nice. But what's happened at Gentian, our next bi-weekly podcast is going to be on Wednesday, March the 18th. And that is going to be regarding the new retirement mindset, what's changed in the last 5 years. As we talked about, everything changes. So, and then on that same day, on that Wednesday, we have our March birthday club at noon. So I know there's been invitations that have been sent out, so please sign up for that. If you have a March birthday, we'd love to see you, and hopefully it'll be beautiful. And then our save the date for Ladies and Gentian is on Wednesday, March the 25th. We are going to be sending out what our topic will be about very shortly, and we hope to have a lot of the ladies on there for that. So please, I think that's been sent out to be emailed to sign up. So sign up for that or give us a call and we can sign you up. And then our in-person at Blue Mound Country Club, we have our spring technology update on Thursday, March the 26th. And that is going to be all the technology that Chris is going to give us come back from when he goes to his conference, and we will get all of those updates. So there'll be lots of information there. So please sign up for that also. I know everything's out on email that you can sign up or on our website. So we will look forward to seeing you all.
Yeah, thank you, Lisa. Like Lisa said, we love spending time with you at these. So you're always welcome. We encourage you to be part of those. We hope they're extremely valuable for you. But most importantly, we just love spending time with you on a personal basis. It's why those birthday lunches occur. It's why we have all of these events, is because we truly view each of you like family. And I also appreciate the reminder about daylight savings. It's funny when you have a child, you kind of calculate the impact of daylight savings with how long or how does that impact their sleep. So Ollie and I were mathing it out on paper of like, oh, wow, that actually could be a positive. Even though we lose an hour, he might sleep until 6:30 instead of 5:30. So that could be an amazing gift for us on our end. But just in closing here, just wanted to kind of summarize a few things that we went through today. And really, when we look through in the simplest form, most bad decisions, financially especially, but even if we look at our life, really come from three emotional states. Really, the first one is that comes from fear, right? So in our regards to our investments or financial plan, it's really making a bad decision when things don't look good because of the fear that it creates. The second one is greed, the almost the opposite end of that, which we're actually starting to hear and feel a little bit over the last 3 years of how good things have been, is chasing returns or that fear of missing out, or I need to be in this, or I need to achieve extra returns for this. And then the last one is really just the impatience factor, which is extremely important as well, is just expecting short-term results from long-term strategies. When we look at our life, everything through the lens of fitness makes sense to me, where imagine putting an amazing plan into place that's designed for a year or 2 years down the road to improve your health. And after 2 weeks, you give up on it because you don't see the results that you're anticipating ahead of time. So really managing those expectations and controlling our patience, and really just the market in general has climbed the walls of worry for decades. Despite all the crises that have occurred and all the crises that will occur moving forward, there will be substantial, extremely scary corrections of 20 or 30% that's going to feel like the end of the world, and lose confidence and lose faith in these. But despite all of those, businesses keep building, they keep innovating, people keep working, and economies keep growing over time. So really, all of these are why the tenants here at Gentian to be successful, and most importantly, to live your most meaningful and joyful life, regardless of what season you're in, that it really requires those three tenets that we constantly bring up and talk about, that it requires faith, patience, and discipline. And truly, like I said, with the different events, is we're just honored to be on this journey with you, and to have you have chosen us to be your guide for these journeys that you're on is just, it's extremely humbling, and we're extremely grateful for that. So with that, from our global or our galactic headquarters, as Chris would say, we just really appreciate you and hope you have a great rest of your week. Thank you all.